Are you looking at a massive breakout? Or are you stepping right into a classic retail value trap?
I mean, that is the multi-million-dollar question today, especially when the data we're looking at is just, actively contradicting itself.
Yeah, it really is. So today is April 15, 2026,
Hmm.
and we are putting Sidus Space Inc. under the microscope. The ticker symbol is SIDU.
Right.
And if you've been watching the tape, you already know this stock is behaving like it has a completely broken throttle.
Hmm.
We're seeing extreme, almost violent volatility.
Oh, absolutely.
Over the past 2 weeks alone, Sidus is up an incredible 110.34%. I mean, it literally doubled. But then, today closed down 8% to settle at $4.88.
Which is a near 10% haircut in a single afternoon. Right on the heels of a parabolic run, too.
Right.
That kind of whiplash, it usually shakes the weak hands right out of the market.
Totally. So our mission for this deep dive is to tear through the financials, the technical analysis, the insider buying, and the latest news to figure out what is really driving this.
Because we need to know, is this a fundamental shift in the aerospace sector or just a temporary sugar high engineered to trap retail capital?
Exactly. Now, before we get into the weeds, just a quick disclaimer. This is an analytical deep dive. We are dissecting data, SEC filings, and chart mechanics. This is not financial advice, so always do your own research.
Yep, do your own homework.
And if you're navigating these kinds of battleground stocks with us, do us a favor. Hit that like button on the video, subscribe to our YouTube channel, and definitely leave your verdict in the comments. Your feedback directly shapes where we point the microscope next.
And this is a stock where the comment section is going to be incredibly divided.
Well, for sure.
Because the fundamental narrative and the technical reality are currently living in two completely different universes.
Well, let's start with the technical reality then. I mean, nearly 30 million shares don't just change hands in recent sessions because of a press release.
No, not at all.
This volume is reacting to something structural. So to figure out if that 8% drop today is a dip buy opportunity or, the trapdoor finally opening, we really have to look at the machinery of the trade.
Right. And the machinery right now is driven by pure aggressive momentum. Just look at the 52-week swing.
It's massive.
It is. This stock was sitting at a low of 0.6278 cents. I mean, literally pennies.
Wow.
And it recently hit a high of $5.59. That is an explosive move that heavily skews all the short-term indicators.
So where is it sitting relative to the moving averages?
Well, right now it's trading significantly above its 50-day moving average, which sits at $2.56. But more dangerously, it is miles above its 200-day average, which is way down at $1.84.
Okay, let's unpack this because trading this stock right now feels less like investing and more like trying to board a bullet train while it's moving.
Yeah, that's a good way to put it.
The momentum will take you incredibly far if you catch it perfectly. But the technicals show the train is vibrating so violently off its tracks. I mean, trading more than $3 above that $1.84 long-term average, it could completely derail before you even find a seat.
Exactly. And that structural tension is what algorithmic traders look for. You see, moving averages act like gravitational pulls.
Right.
So the further the price stretches away from that 200-day baseline, the stronger the mathematical probability of a violent mean reversion. A snapback.
But counter to that, I'm looking at the MACD, the moving average convergence divergence, and it's sitting at 0.171. It's actively flashing a positive buy signal.
Yeah, it is.
Break the mechanism of that MACD signal down for us. Because it's easy to just see buy signal on a screener and blindly throw money at it. But what is mathematically happening under the hood to generate that?
So what's fascinating here is that the MACD is essentially a race between two moving averages, usually the 12-day and the 26-day.
Yep.
When it flashes positive at 0.171, it means the short-term momentum is mathematically overpowering the long-term trend. The 12-day average has crossed up and over the 26-day average.
Oh, I see.
And this triggers automated buying from quantitative algorithms that are programmed to blindly follow short-term trend strength, which, only pours more gasoline on the fire.
It becomes a self-fulfilling prophecy then. The algorithms buy because the momentum is strong, which makes the momentum stronger, forcing more algorithms to buy.
Exactly. Meanwhile, the 14-day relative strength index, the RSI, is sitting between 57.36 and 68.27.
So it's knocking right on the door of that 70 level, which is overbought territory.
But it's getting very close.
But here is where it gets really interesting to me. The short interest. We're looking at 11.80% of the float. That's about 7.43 million shares sold short. And that short interest just increased 8.49% month over month.
The shorts are actively piling in.
Wait, if short interest is climbing month over month, While the stock is simultaneously up over 110%, that means institutional money is stubbornly betting millions that this bullet train derails.
I absolutely are.
They are looking at the same NCD signals we are, but they're taking the other side of the trade. I'm looking at this chart, and if this momentum breaks, I don't see a soft landing.
No, it would be pretty brutal.
Like surfing a massive, unpredictable wave.
Yeah.
It looks thrilling, but if you don't know where the reef is, you're going to get wrecked. Let's point out the reef for us. If the immediate support level at $4.31 breaks, it looks like empty air all the way down to the next floor at $2.69. Is there any structural support in between?
Not really. You've identified the air pocket perfectly. Because the stock moved up so fast from $2 to $5.50, it didn't spend enough time at the $3 or $4 levels to build up a dense history of buyers.
Right, there's no foundation.
Exactly.
Yeah.
That means there is very little structural support. If the sellers overwhelm the buyers at $4.31, the stop-loss orders will trigger, and the stock could cascade down to $2.69 incredibly fast.
Yeah.
And the flip side of that equation is the strict resistance near the recent pivot top, between $5.32 and $5.59. It has to break through that ceiling with heavy sustained volume to prove this rally has any real long-term structural integrity.
So it is effectively boxed in between a brittle floor at $4.31 and a heavy ceiling near $5.59.
Precisely.
Now that we understand the technical trap, let's shift to the catalyst. The technicals are stretched to the breaking point, but something ignited this engine in the first place. What is generating this 30 million share volume wave?
Well, we have to divide the catalyst into two buckets, the psychological and the fundamental.
Okay.
On the psychological front, there is a massive SpaceX halo effect gripping the market right now.
Oh yeah, space is everywhere.
Right. The broader commercialization of space is dominating financial media, and it creates this intense retail FOMO, fear of missing out. People want exposure to the space economy, but they can't buy SpaceX. So low-float space stocks like Sidus become the primary pressure valves for that speculative cash.
The rising tide lifts all rocket ships.
Oh.
But psychological hype doesn't usually sustain 30 million shares of volume without some fundamental bedrock underneath it.
No, it doesn't. And that bedrock is the Missile Defense Agency's SHIELD program.
Oh, yeah.
Sidus Space was selected for this massive $151 billion IDIQ contract. And on top of that, they expanded their Lonestar agreement for Star Vault orbital data storage payloads. They are stacking real defense and commercial space contracts.
A $151 billion contract. Billion with a B.
With a B, yeah.
That is an astronomical headline. But let's clarify how these defense contracts actually dispense money, because I think this is exactly where the retail value trap springs shut. An IDIQ contract doesn't mean the government just handed Sidus Space a check for $100 billion, does it?
Not even close. If we connect this to the bigger picture of government procurement, an IDIQ stands for indefinite delivery, indefinite quantity. It is essentially a hunting license. The government sets a massive $151 billion ceiling for the entire SHIELD program over several years. Sidus winning a spot on the IDIQ simply means they have passed the initial vetting to be on the roster.
Oh, I see.
Now they have the right to spend their own money to build prototypes and aggressively compete against other defense contractors for specific, smaller task orders under that massive umbrella.
Though they didn't win the lottery. They just won the right to buy highly expensive lottery tickets.
Well, that is a brilliant way to phrase it. Yes.
They still have to spend millions on engineering, specialized payroll, and manufacturing just to bid on the actual revenue-generating projects.
Precisely, and that requires immense upfront capital. Which brings us to one of the most compelling yet conflicting data points in this entire deep dive, insider buying.
Okay, lay it on us.
Over the last year, company executives and insiders have purchased 1.78 million shares of Sidus Space.
Wow.
And during that same time frame, there have been 0 reported sells.
Wait, not a single share sold. Which is wild, because normally executives sell shares just to, pay their taxes or buy a house or diversify. Okay, let's unpack this. It's easy for retail to get caught up in space hype, but insiders don't buy 1.78 million shares just for FOMO.
No, they don't.
How much weight should we give to insider buying when the overall market is so volatile?
A lot. 0 insider selling is a highly specific signal. It means the people who sit in the boardroom, the people who actually see the classified task order pipelines for the SHIELD program, believe the future cash flows will dwarf the current valuation.
They're putting their money where their mouth is.
Exactly. Insiders are betting their own capital.
And that insider conviction brings us to the ultimate paradox of this deep dive. Because when we take our eyes off the defense contracts and look at the actual audited books, the narrative completely fractures.
It really does.
Let's look at the financials. The full year 2025 numbers compared to 2024. Wait, how can their revenue actually be down to $3.38 million when they are winning pieces of a $151 billion defense contract? Is this why retail traders get trapped?
It's exactly why. This raises an important question about the brutal reality of capital-intensive industries. On the income statement, Sidus Space's revenue actually dropped year over year.
Okay.
In 2024, they brought in $4.67 million. In 2025, that fell to $3.38 million.
Oh.
And net income plummeted even further into the red. It moved from a net loss of $17.52 million to a massive net loss of $29.47 million.
So they are bleeding heavily.
And the operating cash flow highlights the mechanism of that bleed. It is currently sitting at negative $18.15 million.
Oh, wow.
This goes back to our IDIQ discussion.
Yeah.
There is a massive operational lag in aerospace. You have to hire the rocket scientists, secure the specialized materials, and pass stringent regulatory compliance tests long before you ever recognize a single dollar of government revenue.
And that lag just drains your cash reserves rapidly.
Exactly. But looking at the balance sheet, they did manage to bolster those reserves somehow. Their cash and equivalents jumped significantly from $14.16 million in 2024 up to $43.18 million in 2025.
And total assets are now sitting at $66.09 million against relatively low total liabilities of $15.46 million.
That $43 million is their runway. But when your operating cash flow is burning at $18 million a year and your net loss is nearly $30 million, a $43 million war chest is essentially a ticking clock.
Yeah, the math doesn't give them much time.
They have maybe 18 months to start converting those SHIELD task orders into recognized revenue before the lights start flickering.
Which brings us to the bear case. And frankly, the blaring siren of this entire analysis, the 10K delay.
Yes.
They delayed filing their late 2025 Form 10K with the SEC. Now, in an environment where you are burning $29 million a year, hiding your comprehensive financial health from the public isn't just a yellow flag, it's deeply concerning.
It's a massive red flag.
What are the auditors usually fighting about behind closed doors when a company like this delays?
It almost always comes down to revenue recognition or internal controls. When you deal with complex, multi-year government defense contracts, the accounting rules on when you can legally claim a dollar as earned revenue are just labyrinthine.
I can imagine.
If the auditors disagree with how management is classifying the upfront costs versus the milestone payments on something like the Lonestar agreement, everything halts. The delay creates a massive cloud of uncertainty regarding transparency and corporate governance.
And this is where we hit that aha moment for the listener.
Yeah.
Because we have a massive information asymmetry problem here.
We really do.
We just established that insiders bought 1.78 million shares with 0 cells. But those same insiders are the ones delaying the public 10K.
Exactly.
The retail trader looking at the MAPD buy signals is flying completely blind to the actual audited numbers. While the insiders who are buying the stock have full visibility into the unaudited internal cash flow projections, they see the data we legally aren't allowed to see yet.
That information asymmetry is the defining feature of this stock right now. The insiders either know that the delayed 10K contains incredibly complex but ultimately bullish revenue projections from the defense contracts, which would justify their massive buys.
Right.
Or it's a structural mess, and how the broader market values that disconnect is entirely schizophrenic.
Well, let's talk about that valuation disconnect, because if you look at the ratings, it feels like two different analysts looking at two different companies.
It does. The technical consensus, driven by the algorithms tracking that 30 million share momentum, screams buy to strong buy. Analyst price targets on charting platforms are hitting as high as $10.
Which implies another 100% gain from current levels. I mean, I have a hard time believing a fundamentally bleeding company commands a $10 price target without some severe valuation stretching.
Right.
What do the fundamental metrics actually say?
The fundamentals paint it as severely overvalued. The price-to-sales ratio, or PS, is currently 37.2.
Wow.
And the price-to-book ratio is sitting at 6.9.
Let's put that price-to-sales ratio into context for a second. A PS of 37.2 means investors are currently paying $37.20 for every single dollar of sales the company makes.
Yeah.
If this were a high-margin software-as-a-service company with virtually zero overhead, maybe you can justify a sky-high multiple. But for a hardware-heavy, capital-intensive aerospace defense company, That is priced beyond perfection.
It is priced on the assumption that the $3.38 million in current revenue is going to 50x in the next 24 months based on the Shield contract.
But here is the critical risk that retail traders ignore when they see that $10 price target.
Yeah.
How does the company fund the gap between today's $3 million revenue and tomorrow's hypothetical $100 million revenue?
They dilute the shareholders.
Right.
To survive the cash burn while waiting for defense payouts, companies often rely on shelf offerings. They issue millions of new shares into the open market. This immediately dilutes the equity of the retail traders who just bought the top.
Yeah, it's a trap.
You could be right about the company's long-term success, but still lose half your money because your slice of the pie just got cut in half to fund the factory.
So when we weigh the undervalued versus value trap debate, it really comes down to time horizons and execution.
Yeah.
Let's lay out the concrete outlooks. Give us the best-case bull scenario and the worst-case bear continuation.
Okay, so the short-term outlook is completely dictated by momentum. If the FOMO continues and the algorithms keep pushing that MACD, it could test that $5.59 ceiling.
And long-term.
Long-term, the best-case recovery scenario requires flawless execution. They must use that $43 million cash reserve with incredible efficiency. They have to win highly profitable task orders under the $151 billion Shield ceiling, and the delayed 10K needs to drop with a clean bill of health from the auditors.
Big ifs.
Huge ifs. But if that happens, the revenue catches up to the hype, the PS ratio normalizes, and those insiders look like absolute visionaries.
And if they stumble, if they dilute to survive, that $10 price target is a total mirage.
The worst-case scenario is the cash burn eats them alive before the defense money arrives. The delayed 10K reveals systemic accounting flaws. The momentum traders get spooked by the uncertainty and pull their bids, and the stock cascades through that $4.31 support level.
Dropping through that air pocket.
Exactly. And if they are forced into a massive shelf offering at depressed prices just to keep the lights on, the dilution spiral will drag the stock right back toward its 52-week low of 62 cents.
So what does this all mean? To summarize this incredibly complex deep dive, Sidus Space is existing in two completely distinct realities.
Very true.
In the first reality, it is a technical juggernaut. It is riding a massive wave of defense contract headlines, buoyed by the SpaceX halo effect and backed by a staggering level of insider confidence with executives hoarding shares.
But in the second reality, it's a fundamental bleeder. Revenues are actively shrinking, net losses are expanding, the cash burn is ticking louder every quarter, and they are hiding their audited financials from the public.
Which makes this one of the most dangerous and honestly fascinating battleground stocks on the market today. As a final reminder, our breakdown of these mechanisms, the technical charts and the SEC filings, is strictly an analytical deep dive. It's not financial advice.
Right. Always consult a professional and map out your own risk tolerance.
Absolutely. Especially in a stock with a near 12% short interest. The market is entirely unforgiving if you trade momentum without understanding the underlying mechanics.
It really is.
Before we sign off, I want to leave you with one final provocative thought. We talked heavily about information asymmetry today. We know corporate insiders are confidently buying up 1.78 million shares with absolutely zero sells.
Yep.
But we also know that, at this exact moment, the company is refusing to release its audited 10K financial filing to the public. So ask yourself, when the people running the company are buying the stock, while simultaneously keeping the financial reality hidden behind closed doors, what exactly do they see in the upcoming defense pipeline that the delayed paperwork isn't showing you yet?
That asymmetry is either the ultimate edge or the ultimate trap.
Thank you so much for joining us on this deep dive. Don't forget to like this video, subscribe to the channel, and jump into the comments below. We want your final verdict. Is Sidus Space a massive breakout or a classic retail value trap? Let us know, and we will see you on the next deep dive.